This is the fourth in a series of webinars. The first was in the middle of last year, at the sort of height of the crisis financially for the financial system, as opposed to epidemiologically. So that was the first webinar was on staying invested through the crisis. The second webinar was about interest rates and how long interest rates will stay low and the effect it'll have on property prices. And then the third webinar was on quantitative easing and the effect on US stocks, and how we should think about the uncertainty about what's going to happen to inflation and the withdrawal of quantitative easing in the United States. And this one is about real interest rates. It's the fourth of our webinars, is about real interest rates and inflation and the effect on property prices and how private investors like you and me should think about that. So let's jump into this. Write your questions in the Q&A, and we'll come to the Q&A once we get to the end of our slides. Rising inflation and low interest rates, how can investors benefit? So here's where we're going to go. What's happened to interest rates and inflation since 2012? That's the first thing we're going to talk about. And what we're going to see is that interest rates have come down tremendously, but inflation has actually gone up just recently in COVID-19. And that's had a very diminishing effect on real interest rates. And then we're going to go to what does that mean for holders of cash? Well, it means negative real interest rates, where we have zero actual interest rates, the cash rate and deposit rates being approximately zero, but inflation being quite high at 3.8% at the moment. Not really any significant prospect of interest rates going up in the deposit rates going up over the next 2.5 years. So whatever inflation is over the next 2.5 years, that's the negative return that you're going to receive on deposits. So if you have a very large amount of cash at the moment, then the negative real interest rates that we're facing over the next 2.5 years and beyond is something that simply can't be ignored. We're going to see how large the change in interest rates has been, how significantly negative real interest rates have become, and investors of every kind can't ignore that, but especially people who were heavily into cash before the crisis and through the crisis. And then we're going to have, what does the massive decline in real interest rates mean for residential property prices? That's going to be a lot of our discussion here. Then we will be into how has it affected the returns to negative gearing down here. So we're going to discuss negative gearing when we have negative real interest rates. We'll see how strongly negative real interest rates affect negative gearing. That's going to be the biggest part of our conversation. Is negative gearing in general a good or bad strategy in an inflationary environment? We're going to see that in general, it's good. Inflation is good for negative gearing. We'll see how that works when we go through talking about the tax aspects of negative gearing. What are the risks? And here we mean, what are the risks that attend borrowing to invest? And of course, borrowing amps up returns, but it amps up risk as well. We're going to see that borrowing increases risk and returns linearly with leverage. And I'll explain what I mean by leverage, and I'll show you the diagrams and also work through some examples to bring that out. So we have the ordinary amount of amplification, gearing, leveraging, all of those things are the same in this context, of risk that goes with adding debt to our investing. But just in general, in managing risk of borrowing to invest, borrowing to invest is great if you're a long-term investor and you're sufficiently to the right on the risk spectrum for that to make sense for you. But there will be times over the journey where if you have too much debt, you'll be forced out of your position. So the general risk associated with borrowing to invest is just the notion that there will be times, if you borrow to invest, your wealth will grow more quickly. I'm going to see this more explicitly rather than me just waving my hands around. We're going to see this explicitly in the examples. You'll get higher returns if you borrow to invest, and your wealth will grow more quickly. But from time to time, the market will move down dramatically. And if in that downdraft, you are forced out of your position, what will happen is the bus will slow down, you'll get off, you'll be forced out of your position, and you'll get off with your pockets empty. Now, that has happened 1 million times in the past. People have borrowed too much to invest. They haven't been able to hold their position through the downdraft and back up into the updraft, and they've been forced out at the bottom of the market, and they've lost all their money. So that's the general risk associated with being a long-term investor who is borrowing to invest. But we're going to talk about the risk quite a lot as we go along. What do record real interest rates mean for shares? We'll be talking about negative gearing. Now, you can negatively gear shares. This is really a topic for my investments course. We don't talk a great deal about negative gearing of shares, but that topic definitely comes up. It's kind of aggressive to borrow to invest in shares at all, but we do talk about that quite a lot in my investments course. But you certainly can negatively gear shares, and we'll come to that in our discussion as we go along. Why are interest rates so low? If inflation is rising, I'm going to spend the second half of our talk talking about that, maybe the last third rather than the second half. How long will it last? Well, maybe 2.5 years, maybe well into 2024. That's when I expect the cash rate to rise in 2024, and I'll show you why that's true. And I'm not alone. The governor of the Reserve Bank, Philip Lowe, thinks that that's when the cash rate will rise. And he, unlike me, actually has his hand on the lever of the cash rate. Now, speaking about the cash rate, here is the cash rate for Australia over the last 30 years. And you can see that it's fallen dramatically. We go back here to 2012, which is going to be the benchmark year that we're going to use here. We can see that interest rates have just been down, down, down. Now, an important thing to note here is that interest rates, the cash rate, the rate set by the Reserve Bank, the headline rate that we all sort of hear about on the ABC or read about in the Financial Review, the rate set by the Reserve Bank, the cash rate, that was cut to a record low before COVID-19 started. Now, it's really essential to remember that. It's essential to remember the context of the global economy that COVID-19 sits in. COVID-19 didn't come around until the beginning of 2020. The first person died in Wuhan, as far as we know, on the 9th of January 2020. And it will pass into the rear vision mirror at some stage. But before it and after it is the context of powerful deflationary forces in the world. And they had forced interest rates to record lows in Australia before COVID-19 came along. Now, that's the world we ultimately go back to. And we can see here what's happened to inflation. Let me just remake my point here, that interest rates have gone down, down, down since 2012. We would expect that inflation had fallen with interest rates falling like this. But in reality, inflation has gone from the mid-twos in 2012 up to 3.8%, where it is today. So paradoxically, interest rates way down, inflation actually up. Now, the effect of that, and the reason that we're having this webinar to discuss the effect of that is that we have powerfully negative real interest rates, the likes of which haven't seen before, really, given the way that the financial system is structured now. You can only really think about the financial system being the way it is since the Second World War, and this has never happened before. Now, when I say real interest rates, what I mean is the cash rate, the rate set by the Reserve Bank. Don't worry about the 90-day bank bill swap rate here. That's the black line. It's the red line that we're interested in, the cash rate that we were looking at just a moment ago. Now, if we take the cash rate and subtract out inflation, that's the real interest rate. Real in the sense of the return that you're getting, how much stuff can you buy? We've got to take out the effect of the price of stuff going up before we can see how much extra stuff we can buy. That's what the real interest rate is. That's what real anything means in economics, is that we've taken out the effect of inflation and gotten down to real things as opposed to nominal things, which is what they would be. Nominal meaning in name only, and that's what they would be if we included inflation. Now, if we go back to before the GFC, this big dip here is the GFC. If we go back to before the GFC, what we would see is a world where real interest rates at the left-hand side of the yield curve, or let me say, more normally, the shortest interest rates, the cash rate, what we would see is that the real interest rate is about 2%. And if our graph went back even further than it does, it'd still be around about 2%. So before the GFC, what we're looking at is cash rates which are about 2% above inflation. And then from 2012 onwards, that tumbles down. We get down to from 2% down to 1%, and down to 0. And what's happening here is that interest rates are falling faster than inflation. Interest rates are falling off a cliff, as we saw before, and as we can see in this graph, and inflation is not as falling as quickly as interest rates are. And so the real interest rate is being compressed, and it gets compressed down to 0. This means that the cash rate and inflation are approximately the same. And then even before we go into the GFC, even before we go into COVID-19 here, what we see is that real interest rates fall down to about 1%. This is what actually precipitated this fact that the concern about deflationary forces causes the central bank to cut interest rates. But in any case, real interest rates fall down to about minus 1% here. So inflation is at 1%. So when we have inflation of 2% and we have a cash rate of 1%, we've got the cash rate of 1% minus 2% inflation down to a real interest rate of minus 1%. And then what happens, of course, is COVID-19 comes along, the cash rate goes down to zero, inflation has now gone up, and that's pushed the real interest rate down into very negative territory. So in 2012, we're at 1.5%. And in 2021, we're at minus 3.7%. Now, this is a historically large difference. This massive decline in real interest rates, investors can't ignore that. This is absolutely something that you can't ignore. It's not about to go away in the next 6 months, and it's not a small thing. This is a structural reality that investors have to factor into their strategic thinking about investing. Either you or whoever manages your money for you has to understand that and think it through carefully. And that's, of course, a part of that thinking is what we're doing here. Understanding what this means, principally for investing in property. But this is a massive and historic change. This is a lowering of the cost of debt capital. This is turning people who used to be lenders into borrowers. Now, when the real cost of money is minus 3.7%, then do you want to be a lender or do you want to be a borrower? And so it's like wages, right? When wages are very high, do you want to be an employee or an employer? Well, if wages go from being high to being negative, people will work for less than free. People will come around and someone will come around and wash my car and clean my swimming pool and mow my lawn, and they'll pay me to do it. How many of those people do I want to come and do that for me? Well, a lot, okay? Well, I've only got one swimming pool, and I don't even own a car anymore. So, but in any case, it's a historic change in the cost of capital. It used to be, if you parked your money in the bank, you would get about 2% more than the inflation rate. And now, if you park your money in the bank, you'll get about 4% less. You'll get an interest rate that is about 4% less than the inflation rate. Inflation at 3.8%, the cash rate at 0.1%, so a minus real interest rate of minus 3.7%. This turns lenders into borrowers. And, we can't ignore that. This is not about to go away. Okay, so what does the massive decline in real interest rates mean for residential property investors? This is where we're going in the next few slides. And what we're going to find is that the risk-reward trade-off that attends borrowing to invest gets a lot better, that you get more reward per unit of risk that you take when negative real interest rates go down. Borrowing to invest becomes more attractive in that respect. Reward for taking the risk of borrowing to invest is larger when real interest rates are lower. And consequently, borrowing to invest in property has increased greatly around the world, everywhere around the world. Investors have good intuition about this. If the cost of capital is very low, negative, then do I want some of it? Yes. And what can I borrow against? Property. Most people can't easily borrow against anything else, to a certain extent, against shares, but mostly against property. People have good intuition. People who used to be lenders are turning into borrowers. What can I borrow against? Property. Let me borrow and invest in property. And that's happening everywhere, quite frankly. And the cause of it is this collapse around the world in real interest rates. It actually has more than one cause, but that's a principal cause of it. Okay, now what I want to work through here in this example, is a mortgage in 2012 and look at the components of that, and then jump forward to 2021 and look at the components of a mortgage today. But let me just go back to 2012 and look at the world in 2012. So what we have is a cash rate of around about 4%, the RBA's cash rate, and that's made up of inflation and 1.5% real interest rate on top of inflation. And then on top of that, we've got a mortgage spread of 2.5%. So this is principally the difference between the rate at which banks can borrow money from depositors, have to pay them approximately the cash rate, maybe a bit more than that, that they can borrow from depositors and then lend to borrowers, lend to people who want to build or buy houses. That's actually referred to as the net interest margin, the difference between the rate at which banks can borrow money and lend money. And in Australia, that's about 200 basis points, about 2%. So this mortgage spread isn't all net interest margin, but nonetheless, it's quite stable, this figure, how much extra mortgage rates are on floating rate mortgages above the cash rate. So after the GFC, it went way up to over 3%. It came down. It's now down around 2.5% again. But it's a fairly stable thing. It's this that's very unstable. And in particular, the blue part, which used to be stable, has gone way down and way into negative territory. So now what we have is this, a mortgage rate of 2.6%. So if you were to go to, let me recommend a site to go to look at mortgage rates. I like Rate City. I'm not trying to run ads for anyone here, except for myself. I'm going to run an ad on our investments class at the end, but not trying to run an ad here for Rate City. I just like them a lot. They have a very good calculator here. And if we went to Rate City and we were to put in here that we want, let's say we want a loan for 800K and it's $1 million property. So let's say the loan to valuation ratio is 80% and we want it to be variable rate and we want it to be interest only. So I'm assuming that this is interest only. This is an investment property, I'm assuming, rather than a principal residence. So if you're an investor, why would you want to have a principal and only mortgage? That's the subject of, we talked about that in our second webinar, so I won't reopen that. Anyway, what we'll get to here is approximately 2.6% as our mortgage rate. And that's the figure that I'm using over here. And that's what you'll find if you go to there and have a look at it. I'm sure you've had plenty of good looks at what mortgage rates are like at the moment. But in any case, that 2.6% will be made up of these things. It's not the mortgage spread, the interest rate charged by banks above the cash rate, that has changed. That does go up and down by an amount of tens of basis points, maybe 0.2% up or 0.2% down over time, but it's pretty stable for good structural reasons. And inflation, of course, has gone up in the stimulus of COVID-19, and it's the real interest rate that's gone down. The real interest rate's gone down from 1.5% down to minus 3.7%, and that's really, despite inflation going up, that's what's taken us down to mortgage rates of 2.6%. Okay, so we're going to work with these two mortgage rates, 6.5% in 2012 and 2.6% in 2021. And we're going to see what the effect is of this 5.2% reduction in real interest rates. Now, our 2012 mortgage, let's take this example. So our rental property is going to be a house in a leafy suburb, not an apartment, not a house on the outskirts of the city, not an investment in a remote centre or a regional centre like Wollongong or Bendigo, but a house in a leafy suburb. Now that choice, that placement of our investment in a house in a leafy suburb, that's a strategic decision. But we're not talking about how we arrived at that strategic decision here. That's a subject for my investments course, talking about investment strategy there. Let's just assume that we've chosen a house in a leafy suburb. Why we might do that and what the advantages of that over other investments are, again, that's my investments course. But in any case, here we're expecting a rental yield, a net rental yield of around about 2%. This might be a little bit too much. Maybe this would be something more like 1.5 to 1.7%, but I'm not looking for exactitude here in my example. I'm looking for round numbers that are going to help bring out the idea without having to do too much mental arithmetic. But what I'm thinking here is the rent. So we're going to have about $20,000 rent after we've paid for things like the agent's fees, insurance, land tax, if that applies to us, rates, etc. So this is our net rent, 2%, 20K on our $1 million property. Now we're expecting a real price growth here of 2.5%. Now that might be a little bit ambitious. There are some structural headwinds ultimately over the next 30 years against residential property. I personally think, and let me be clear about Sam's opinion and what is economic science, I personally think the property prices will go up a lot from where they are now, that they'll zoom up over the next 12 to 18 months. I know they've gone up a lot already, but more to go. That's my opinion. And then they'll flatten out. Now, it's a characteristic of property prices that they zoom up and flatten out, zoom up and flatten out. And if we have more time, we talk about that. That's really a subject for my investments course as well, why the evolution of property prices is like that. I think that's what's going to happen here. They're going to zoom up more, maybe 15% more, if I have to choose a particular number, across the whole of Australia, 15% more if we average across the whole of Australia over the next 12 to 18 months. And then they're going to be flat for a considerable period of time. So this might look a little bit ambitious in those terms, but nonetheless, this is in 2012, of course, so we're looking back in history, but I'm going to use the same figure when we come to 2021. And we can talk about whether that's a bit ambitious and what it'll mean for our figures in just a minute. But let's go with that. 2.5% real price growth, property prices growing at the same rate that the economy grows. Inflation and the real rate, we're not expecting it to grow, the property stock to grow as a percentage of GDP. So this is a natural figure to choose. Okay, now that's going to give us a total return of 7% on our investment. Now let's emphasize here the total return, the sum of both income and capital gains. So we're looking at capital gains here of 5%, $50,000 on our $1 million investment in the property, and 2% in income. Total returns are always income plus capital gains. If we were buying shares instead of buying property here, then we would expect to receive dividends and we would expect the value of the shares to go up. And we would describe our total return, the increment to our wealth. Now we need to consider taxes, which we're going to do in some detail in just a moment, but we would consider the increase in our wealth to be the combination of income and capital gains. I mean, that's the definition of total return. But this will be realized as cash, of course, and this won't be realized, capital gains, until we sell the property. That's always true in capital gains. But we're expecting a return here of 7%, made up of the rental yield, real price growth, and inflation. Now, let's start to look at this in risk terms. Let's break this out a little bit and draw ourselves a diagram which brings out risk. Let's just start off with the balance sheet, and we'll start off with no debt. So in a minute, we're going to introduce 80% debt, but let's just start off with no debt. So we've got our $1 million house, that's the asset. We haven't borrowed any money to invest, so we've got no debt. So it's all equity. We put in $1 million of equity in this part of our example, which is just getting us rolling. The return on the asset, 7%. That's what we were just talking about a moment ago. And the return on the equity, they must be the same thing. There's no debt. So the return on both sides of the balance sheet must be the same. So we're expecting a total return on our equity of 7%. Now, what we want to think about is what happens to that return on equity when we start to borrow. And instead of having $1 million of equity and no debt, we have $800,000 of debt and $200,000 of equity. What's going to happen to the expected total return? That's what we want to think about here. What's the extra reward in terms of expected total return versus the extra risk of borrowing to invest? Because this leverage is going to drive up our reward in a linear way, but it's also going to drive up our reward in a linear way as we start to borrow to invest and go from where we are at the moment, zero debt and $1 million of equity and an expected return of 7%. As we start to borrow at less than 7%, our return on equity will go up in this linear fashion, but our risk will go up in a linear fashion as well. We're not showing the risk in this diagram, but the riskiness, the volatility of our equity will go up in a linear fashion as well. Now, we're getting extra return, and this is of critical interest to us here in real interest rates going so negative, is it's this thing that's going to change. How much extra return we get per unit of leverage. What we're going to see in a moment is that when we jump to 2021, that line's going to look like that. That once the cost of debt becomes so low and actually goes negative, then in real terms, then the reward versus the risk is going to be a much steeper thing, much more reward versus the risk. So that's where we're going. Now let's bring in the debt here in our 2012 example, and we'll go to 2021 in just a moment, but let's bring in the debt. So 800K of debt. And the cost of debt, the 6.5%, that's the mortgage rate that we had earlier. And that means that we're going to have 200K of equity. But the question is, what's our return on equity? What's our expected return on equity? Well, it's whatever makes this equation work. Whatever 80% times 6.5% plus 20% times something equals 7%. It's still a balance sheet, and both sides still have to balance. This has to have an expected return of 7%, and the combination of debt and equity has to have a return of 7%. So whatever arithmetic makes that work, and it turns out it's 9% that makes it work, but whatever arithmetic makes it work so that this portfolio of 80% debt and 20% equity has the same return as over here, that's what it is. There's no rocket science involved here. This is just the simplest arithmetic. So the equation that we're going to have, so we start off with zero debt. That was our previous example. And $1 million in equity. And the return on equity was just the same as the return on the asset, 7%. And then as we start to increase the amount of leverage, as we go to 8 parts debt to 2 parts equity, then our required return on equity in the levered firm, that's what the L means, the expected total return here is going to go up to 9%. 9% is what's going to make this work. It's going to make the balance sheet balanced. So we're going to this point on our diagram, 800K of debt and 200K of equity. And that's going to give us a required return, or expected return, I should say, of 9%. 9% total return. Now, you might be thinking, that isn't very much extra return for all of that extra risk. And I would agree with you. And actually, a lot of investors would agree with you. And for a long period of time, after 2012, the total amount of money borrowed from banks for investment in property in Australia went down. It wasn't an attractive enough proposition. The cost of debt relative to the return on the assets wasn't an attractive enough proposition. And it's because the relative real interest rate was too high. Now the relative real interest rate is way low. It's a much more attractive proposition. And of course, people are borrowing money hand over fist and pouring into property. So let's take our example forward here. Notice that difference is the slope of the line here. This difference between, and it turns out that this difference is the return on the asset and the return on the debt. This difference between the 7% return on the asset and the 6.5% return on the debt is the slope of this line, this slope here. That for every extra unit of leverage, we're getting 0.5% of extra return. Now, if that doesn't sound like enough, well, I don't disagree. But we're going to see what happens to that in just a moment. We're going to see that at the moment, that number is 5.7%, not 0.5%, but 5.7% for every extra unit of leverage. Okay, now just before we go forward here, let's have a look at this in cash terms. So it's our same example, 2012. And what we've got is that we're expecting that our $1 million property is going to increase by $50,000. We're expecting to get a capital gain of $50,000 per year. Of course, it's going to go up and down. These are not bonds that we're talking about here. This is not a risk-free asset. There's going to be plenty of volatility. And the more we borrow to invest, the more volatility we're going to experience. Some years we'll have lots of capital gains. Some years we may have capital losses. But in any case, capital gains of 50K and income in our example of minus 32K. So our rent, this is the negative gearing, our debt payments of minus 52,000, the 6.5% on the 800K mortgage, minus 52,000 going out, 20K coming in. So a net loss of 32K. Now you can see here, the negative gearing is a strategy of turning pre-tax income into capital gains. That's what negative gearing is. That's the essence of the strategy of negative gearing. It's a tax strategy, and it's associated. It's caused by two things. One, in Australia, you're allowed to consolidate losses on a property, on financing net losses on a property, the minus 32,000, with your income, with your labour salary or whatever income you have. You're allowed to consolidate your positive income from your salary with the negative income from the property. So we're taking pre-tax income and we're turning it into capital gains. So that's first thing is that consolidation. The second thing is the difference in the tax rate for income and for capital gains. Capital gains tax is half the income tax rate. If you're on the 47% tax rate, let's hope that you are, because it means that you got a good income. If you're on the 47% tax rate, then capital gains are taxed at half that rate. So your income at 47%, but capital gains at half that, 23.5%. So the combination of being allowed to consolidate losses on property with your labour income, and in most countries you cannot do that. You certainly can't do that in the US, and you can't even do that in the UK anymore. It's being able to consolidate your labour income with losses on property, and plus the difference between capital gains tax, it being half income tax. Those two things together create negative gearing strategy, the essence of negative gearing strategy. And we can see it here. It's a strategy of turning income, which is taxed at the full rate, into capital gains, which is taxed at the half rate. Now, our total return is 9%, as we were looking at just a moment ago. So this is really just the same 9% that we had just a moment ago. Now, let's press on in our example, otherwise we'll run out of time. And we've jumped forward 9 years to 2021. And what's changed? Well, we haven't changed the real price growth. Now, we can change this assumption in just a moment, or you can change it later on. But let's, for the purposes of apples and apples comparison, let's keep our 2.5% here. Inflation's gone up to 3.8%. We're going to keep our rental yield, and let me acknowledge again that this is likely to be more like 1.5 to 1.7%. If we were talking about an apartment, net rental yield would be more like 3.5 to 3.7%. But in any case, this is, and so what we've got here, if we just work through our cash example again, jumping forward to 2021 and not having any debt yet, what we're expecting is 8.3% instead of 7%. And the only thing that's changed is inflation's gone up by 1.3%. So far, the only thing that's changed is that this is 8.3% instead of 7%, and it's all about inflation, capital gains, and income. And now we're just going to bring in our debt again. But notice that now, instead of this difference being 0.5%, this difference is now 5.7%. And what it takes to make these two things add up, 80% times 2.6%, 20% times something, to be equal to 8.3%, is just a much bigger number. Now, when we come down here, it's the same as before, but now because of inflation, return on our assets, 8.3%. Now we've got a much steeper line. The steepness of this line is the difference between these two things, return on the asset and the return on the debt, and that's now 5.7 instead of 0.5. Come over here to our diagram, and instead of 9%, we got 31%. Now, look, I'm not saying that if you invest in property, you'll get a 31% return in any particular year. I personally think that property is going up a lot in the next 18 months, and then it'll be flat for a long time. But a longer discussion of strategy, we should do that in a different forum, maybe even in a different webinar. But in any case, we're really just bringing out what the arithmetic of heavily negative real interest rates means for property investors. And you can see it here. And we can see how much the slope of this line has changed and where we were before and how much it's increased. So in 2012, for every extra unit of leverage, we're getting 50 basis points, 0.5%, and now it's 5.7%. And we can talk about whether my assumption about the real, about whether property prices go up with inflation, and we should expect that to happen over time, that property prices go up with inflation. It might take a little while for that to happen, but there's absolutely no reason for that. But will property prices rise at more than inflation? You know, for some apartments, if we were talking about apartments, for instance, that assumption of a real increase of 2.5% wouldn't make sense. It's only an asset that can't be easily replicated that can grow that much faster than inflation. If we're talking about apartments in the inner city, what we're really looking at is the growth rate in prices of those apartments to be something not much more than the growth rate of the cost of constructing the apartments. You know, that's a much more competitive market with elastic supply. But houses in leafy suburbs, there is no increase in supply. All of the increase in demand to get back to equilibrium has to come about, to get back, if there's an increase in demand, to get back to equilibrium, there has to be an increase in price. There can't be an increase in supply. So that assumption of 2.5% increase, that would certainly be unfounded if we were talking about any asset that was easily replicated. So apartments in the inner city, even house and land packages on the outskirts of the city. But houses in leafy suburbs are a fixed supply commodity, or a fixed supply thing. I shouldn't describe them as a commodity. That's what apartments are, right? Much more like commodities. So in any case, we can talk about whether inflation, how long inflation takes to express itself in property prices, and whether that 2.5% is too much. But even if we took it down from 2.5% to a lower figure, even if we took the 2.5% down to zero, this would fall to 21%. With no real growth, this would fall to 21%. You know, it's the decrease in the real interest rates that are really driving this high figure. Now, that's not going to go on for 30 years, but this slope is going to be high for the next few years for reasons that we'll see in just a moment, because inflation is going to be relatively high compared to recent times. We should expect it to go back down again because we'll go back to the deflationary world, and the cash rate's going to be pegged down at zero by the RBA for an extended period of time. So we should expect an extended period of time, here we're talking about 2 or 3 years at least, where real interest rates are much lower than they have been in the past. And that's what's driving this increase in the extra return relative to risk. And that, as I said before, several times already, is turning lenders into borrowers. And that's a rational response. Okay, let's go forward here. And if we look at this in cash terms, like we did before, I've collapsed the mortgage rate, the 3 parts, just down into 2.6% here. What I really wanted to bring out here is that now in 2021, there's not really any negative gearing going on here, or very little. There's only $800 of pre-tax income that's being used here. Remember, this was minus $32,000 in our previous example? Well, now because interest rates are so low relative to net rentals, in our previous example, this was 20, and down here was minus 52K. And in net, we were taking 32K of pre-tax income and turning it into 50K of capital gains. Well, now we're only taking $800, 0.8K. So negative gearing isn't working for us here. There isn't really any negative gearing going on. Now that has an implication, which I'm going to come to in just a moment, to do with tax. But first of all, let's just note it and then go on. If you have a negatively geared property, then there's no need for me to note it. You would know exactly that it's not really working for you in that sort of tax sense at the moment. In any case, negative gearing is a strategy for turning tax income into capital gains. It can cause, this is where we're going, that's what we've been looking at, but where we're going now is that negative gearing can cause after-tax returns to be higher than before-tax returns. Now, that sounds wrong, that after-tax returns to be higher rather than lower than before-tax returns. It sounds like I've got that the wrong way around and it's a typo, but it's not wrong. And it's what people don't understand about negative gearing. It's what we're about to bring out in our example. Inflation is generally good for negative gearing strategies, and we'll bring that out as well. Negative gearing relies on capital gains, either real or negative. And that, of course, is why my example, I said I wasn't going to talk about strategy, and now I am. But that's why my example is a house in a leafy suburb, because negative gearing is all about capital gains, ultimately. Anyway, let's go forward. Let's go forward in our example here. And we're going to start to look at tax. We're going to introduce tax. So we had this slide before. This is the minus 52,000 and the 20,000. So the minus 32,000 here being turned into 50K of negative gearing. And notice that we're back in 2012, okay? And now we're going to introduce tax. So our return was 9% before tax, our total expected return. And now we're introducing tax. But here's the key thing. Capital gains is going to be taxed at half the rate of income. And the income is negative. And so this is going to be taxed much more heavily than that is. The part that's negative is going to be taxed much more heavily than the part that's positive. Now, what that means is this. What we're looking at over here is how much of our after-tax income is needed to enact the strategy. So yes, we need 32K of pre-tax income, but once we jump to after-tax, how much after-tax income is needed to generate the capital gains? Well, we can see it here. Let's see if I just move forward, we can see it here. Negative gearing uses 16,960. Those two cancel out in my example. And down here, 16,960. So not 32,000, that's before tax. Before tax cash, 32,000, but after tax cash that's being used in the strategy is 16,960. So that's how much less after tax cash we have because of our negative gearing strategy in 2012. Now, but it's generating capital gains, and the capital gains doesn't get taxed at 47%. It gets taxed at half that. So it's generating the 50,000 less 23.5% tax, which is 38,250. And because this is 21,000 more than that. Our expected after-tax capital gain is 21,300 more than our after-tax income. This is the overall gain. We've invested 200K. We're expecting an after-tax return of 10.6%. Now, as I said, it seems wrong, doesn't it? After-tax should be lower than before tax in return. And ordinarily, that would be the case. But it's this difference that drives it. And negative gearing is a strategy of turning pre-tax income into capital gains. And it causes this. It causes, when you have high levels of leverage like we do here, and we have positive real interest rates, it causes this to occur, the after-tax return to be higher than the before-tax return. This is the most misunderstood thing about negative gearing, this difference between those two things. Now, let me just actually show you this slide, and then I'll go back to that previous slide and talk about inflation. So here's what I mean. Here's what I mean about turning pre-tax income into capital gains. Let's say that you earn your salary, maybe you got some other income, you might have some income from shares or whatever. And if $2 of income here is allowed to flow through to instead of using it in a negative gearing strategy, if you don't like 2,000, think of 32,000. $32,000 of income, but in my example, $2 of income, just to keep it simple. Instead of going out here to support negative gearing of a property, it just gets taxed. So you don't have a negative gearing strategy. The salary just gets taxed at 47%. Now, if whatever your tax rate is, just plug in the numbers and in the examples we'll be working through, and it'll come out. But here, on the highest tax rate, our $2, if we don't have a negative gearing strategy, turns into each one 53 cents, so $1.06. If instead we send the $2 out and we turn it into capital gains, now we would expect our $2 of income to turn into more than $2 of capital gains, and that's what's happening in our example. Our 32,000 is turning into 50,000 of capital gains. But here I'm just trying to show you, you don't need that growth for this to work. It's not the essence of it. So if we just basically turn the pre-tax income into capital gains, then what happens is one of those $2 gets taxed and the other one doesn't, because capital gains tax is 1/2 of income tax. And because of that, we get 53 cents here, and we still have our dollar here, and we have $1.53. If we send the $2 out and turn it into capital gains, then we'll have $1.53 instead of $1.06. And that's the essence of the tax strategy that is capital gains. It is the leverage strategy. Leverage gives us the negative gearing in normal times, a lot of negative gearing. It's the leverage strategy of turning pre-tax income into capital gains. Now, let's just go back here for a second and have a look at the effect of inflation here. Now, you can see why inflation works for a negative gearing strategy, because it appears down here. So when inflation comes along, what we should expect to happen is that interest rates go up here. Remember that our interest rate is inflation plus, this was the 6.5% interest rate. We should expect when inflation comes along, our interest rate to go up, which drives up how much cash is needed to support the negative gearing strategy. But we should also expect inflation to express itself in the price of the properties. That might take some time. Interest rates are going to go up quickly with inflation. Not so quickly over the next couple of years, but ordinarily we would expect interest rates to go up relatively quickly with inflation. And certainly they'll be hand in hand if there's no change in the real interest rate. But this is taxed at 47%, and that's taxed at half. So what we have to pay gets reduced by 47%, and what we receive gets reduced by 23.5%. You know, what we need here is a strategy that turns pre-tax income into capital gains. And it's not the essence of the strategy, whether the capital gains are inflation, whether they're nominal or whether they're real. That's not the essence of it. The essence is turning pre-tax income into capital gains, and inflation gives us the capital gains. So in general, inflation is helpful for negative gearing. I know that sounds paradoxical as well, but it's just the nature of it. It's just the rude arithmetic of it. Now, when we come back to our other example of the 2021 example, well, in 2021 we don't have any negative, and the result of that, we have a tiny amount of negative. But you know, this is only $800 or whatever it is. There's only a tiny amount more. That's actually only $424, isn't it? We only have a tiny amount of negative gearing going on here. instead of 32,000 going out to be turned into capital gains, we only have $800, 0.8K going out. And the result of that is that the after-tax return is, as normal, lower than the before-tax return. This is what we would ordinarily expect. And once negative gearing goes close to zero, then we get what we normally expect, that the total expected return on equity after tax is lower than it is before tax. The paradoxical thing's gone away. Now here we can just see some data on how much investor, we are saying that investors retreated from the market, but now they're back in force. This is from the RBA chart pack. This, and it lags a little bit. And if we were to jump forward 3 months in our data, we'll see that the investor lending has continued to rise tremendously. It's people, it's turning lenders into borrowers. Okay, so here we have, I just put a slide in here to summarize the things that we were talking about before. So 2012, before tax, after tax, with no leverage. Before tax, after tax, with leverage. And paradoxically, after tax is more than before tax. Jump forward to 2021, where the real interest rate is so low, the negative gearing isn't really being enacted because interest rates are so low relative to the net rents. And we get back to the more normal situation of after tax being lower than before tax. All right, so we're going to go on in just a second, but let me just tell you a bit about my investments course. This will only take 1 minute. It's coming up next Tuesday, so not tomorrow, but the week after. So it starts on the 5th of October. It runs for 10 weeks, 10 Tuesday nights, 7:30 to 9:30 p.m. I guess I should say Australian Eastern Daylight Time. Rather than standard time, because daylight saving will come along. It's easy to forget that in WA because we don't have daylight saving in WA. So there's live classes which run for 2 hours. It's also video on demand. So the video on demand, the recording of the class, which is not actually a recording, it's just pre-recorded, of the class is released straight after the actual class. This runs for 100 minutes. The videos, the classes themselves run for 120 minutes because in the classes, as well as having all of the content for the class, we also have questions, and we also have a discussion of recent events. A lot happens every week, and we talk a bit about what that means for investors. And then we have a bunch of questions, of course, because we don't have too many participants in the class, but those things aren't going on in the on-demand part, so it's just a little bit shorter. Now, there's a lot of videos that support it. So the whole thing has a learning management system. There's a lot of videos. A lot of these videos are about structuring and tax planning, about family trusts, self-managed super funds, borrowing to invest, etc. In addition to the 2 hours of content, there's 2 30-minute videos a week to watch. Half of them are on structuring and tax planning. A lot of them are on property as well. There's a great amount of notes and slides that we use. As I said, it's all loaded up onto a learning management system. And the participants typically talk with me once or twice during the class, meaning for half-hour sessions, maybe halfway through the course and maybe actually after the course, to ensure that they are bringing their investing up to speed. So it's very well organized. Best thing to do if you're interested is the very best thing to do is just to go to our website and enroll, because it's coming up pretty soon and we are getting pretty close to full. So the best thing to do is just to go and enroll. But to get more information, there's a lengthy video here where you can see everything about the course, what all of the content is, the strategy that comes out of it, the 10-step process of self-examination to bring you up to speed on the investment process and the strategy that we have, etc. So I can say without a hint of modesty, people absolutely love the course. So I recommend my own course to you. How's that? All right, that ends that advertisement. Now, what I want to talk about here is the backdrop that I was talking about before, the backdrop of deflationary forces in the world that we had before COVID-19 came along, and that we will go back to after COVID-19, the very long-term deflationary forces. And then I want to talk about these 4 factors: exchange rate through growth, wage growth, and capital investment. These 4 factors mitigate against an increase in the cash rate. Now, we don't know. So real interest rates depend upon what the cash rate is, and they depend upon, let me just bring up pen here. So these 4 things are going to drive what the cash rate is. And of course, the cash rate minus inflation is going to give us the real interest rate. And that's what we've been talking about. That's what's been driving up the slope of our curve, where we have leverage here on the x-axis and the expected return on the investment in property or in shares up here. It's the high, it's the low, I should say, real interest rates. It's the fall of these real interest rates from 1.5% in 2012 down to minus 3.7% in 2021 that's caused this curve to go from being like this to being like that. And the extra return relative to the risk and the effect that that's having on investors. Now, what we want to know is, well, okay, so it's gone from here to here. Well, what happens next? Does it come back to here? Does it come back a little bit? Does it go steeper? And what we're going to focus on here principally is what happens to the cash rate rather than what happens to inflation. And it's much easier to make an argument for the cash rate than for inflation. And we have talked about inflation in previous webinars. But what I'm expecting to happen to the cash rate is that it will stay close to zero, 0.10%, very close to zero, through 2024, through the middle of 2024. So nearly 3 years. Now, inflation is likely to go up and then come down again because there's the stimulus of all of the government spending that's been going on, the terms of trade that we have in Australia, which are meaning the price of iron ore and coal and gas and wheat and the like, as well as all of the services that we provide. The terms of trade have been so good. So there's a lot of inflationary stimulus, but nonetheless, we should expect those deflationary forces in the global economy to reassert themselves and for inflation to go up, but then to come back down again, for the cash rate to stay low for a long period of time. So this might even move out a bit, but eventually it's going to come back in, but not back down to these levels. Okay, now let's talk about the cash rate principally here. But even before we do that, we're going to talk about this decades-long fight against deflation. Now, I've probably shown this graph in every webinar, in all 4 webinars. I bet I have. And I bet I show it in the next couple of webinars as well, because it's just such a dominant thing. And if we take this graph back to the mid-1950s, it's just, flat out here. But what it shows, as I said in the previous webinars, is there's really only been one cycle of interest rates since the Second World War. Up until the early 1980s, it's different in different countries. But in the US, peaking in 1982, and then down, 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 down. And the only thing that stopped us plunging into outright deflation, as opposed to falling inflation, outright deflation, is more and more debt. Basically what is driving this down, what is driving inflation and interest rates down here, and I should remind you that what we're actually looking at here, of course, is the yield on 10-year government bonds. But what's driving this down, of course, is that the growth rate of demand is lower than the growth rate of supply. So these are growth rates, and supply has been growing faster than demand. And what's been making up the difference here is debt, extra borrowing to bridge this gap between the growth rate of supply and debt and demand. Extra household debt, extra corporate debt, extra government debt, and quantitative easing is just extra central bank debt. Extra debt. In 1980, total debt around the world across households, corporations, governments is 100% of GDP in 1980. Jump forward, by the end of 2022, it'll be over 400% of GDP. From 100% of GDP total global debt to over 400% of GDP. Totally unsustainable. Is there a danger that that blows us up? Yes, of course there is. But now I'm just going back to what we've been talking about in the previous webinars. But this is what we go back to. And in the previous webinars, we talked about what is causing this gap between the growth rate of supply and demand. But those factors haven't gone away. Those factors of aging populations, of technological change, of globalization somewhat muted in COVID-19 and post-COVID-19. But those factors, those essential factors haven't gone away. And after the stimulus that'll drive up inflation, we are back to this world. In any case, this is what global growth looks like. And the stimulus came about for the need to get us out of the plunge into the abyss in COVID-19. So I'm not criticizing all of that stimulus, but just notice that I mentioned earlier that we were already at record interest rates before COVID-19 came along. And of course, we went beyond record interest rates down to 0.1%. But it's also true if we look at the Fed's quantitative easing. So I heard someone say on the radio, actually I read it in the AFR, no, not on the radio, I read it in the AFR the other day. Somebody saying that quantitative easing, that the COVID-19 forced the Fed to restart quantitative easing. Wrong. That is simply wrong. Quantitative easing was restarted before COVID-19 came along. It was restarted in 2019. And so, people forget what was going on immediately before COVID-19, and that's what we go back to after COVID-19. So we need to put ourselves into that context. This graph was just to show you how dramatically the RBA has reacted to COVID-19. We didn't have any quantitative easing until COVID-19 came along. And now it's almost like, it's like our RBA is sort of thinking, oh, that thing that all the big kids can do, we can do it too. And we need to catch up. And we've jumped from, I shouldn't be too disparaging, but they have sort of rather over-egged the pudding, the RBA. And we've jumped all the way up to 25%, beyond 25% of GDP. Now there's a different scale on this side of this diagram. And criticising RBA and using their slide at the same time, by the way, never mind. But there's a different scale on this side of the slide here. Over here, the scale is 5 times higher than it is over here. So you shouldn't think that our quantitative easing is a lot more than it is over here. It's just that the US, the UK, and Europe, and especially Japan, wouldn't fit on this graph. But we are rapidly catching up with huge amounts of quantitative easing. So now we are into the reasons why I don't think the cash rate will be raised until mid-2024. Now, here's the first of them. And this is maybe the hardest one to understand. But it's a good idea not to leave the hardest things to the very end of any presentation. And we are close to the end. But this is the RBA's balance sheet. This is their assets on this side and their liabilities on this side. I don't know what I was thinking when I put assets on the right and liabilities on the left. I don't know what caused me to do that. But in any case, these are the assets of the RBA. And this is the lending to the banks. This is the term funding facility, which we talked about in previous webinars, especially webinar 2. This is them lending $200 billion, actually $188 billion to the big banks, essentially for free for 3 years. So these loans, most of these loans will come to an end in April, May, June, in the first half of 2024. These loans will get paid off and this will disappear. And then this is lending to the federal government. So this is the buying of government bonds. You can see down here, domestic bonds. And these are almost all federal government bonds. And they're mostly 3-year bonds. They're actually a variety of bonds, but a lot of them are 3-year bonds. And it's because the RBA has been pegging the yield on 3-year government bonds at 0.1%, as we talked about previously. But 3-year government bonds, there's actually a variety of bonds across the yield curve, but mostly 3-year government bonds, 3-year lending to the banks. And this matures in April, May, June of 2024, same down here. Now, they're not getting any interest on these assets. 10 basis points here, 10 basis points here, as close as anything to zero on this $500 billion of assets. Now, over here, we have their liabilities. And this causes this in a way that we talked about in previous webinars. I'm not going to rehearse here. But suffice to say that the green bars here are deposits of the big banks, or all of the banks in Australia, but deposits of the banks and building societies and credit unions at the RBA. Just like you and I have our deposits at our bank, ANZ or NAB or Westpac or whoever. This is we have deposits at our bank. The banks have deposits at their bank, at the RBA. And you can see that before COVID-19 came along, they're just enough to run the payment system. These are called exchange settlement accounts. Just enough to make the payment system work because the big payments go through those accounts at the RBA. But this quantitative easing and term funding facility has caused this over here. So these banks now have $400 billion of deposits at the RBA and they get zero interest on them. Now you wonder what's going to happen to deposit rates as we go forward. Well, if you take your money to the bank at the moment, they have to essentially, they would love to lend it out, but they only have so many lending opportunities. And there's just such a tidal wave of money into the banks in terms of deposits that it's going to end up, if you take your money to the bank today, it's going to end up in their bank at the RBA, where they get zero interest. So how much interest are they going to pay you? If they just take it off your hands and put it in the RBA and get nothing, how much are they going to pay you? Well, that's easy enough to work out. And that isn't going to change anytime soon. Those rates are not going up anytime soon. Now, let's say that the RBA was to raise the cash rate. So the RBA was to raise the cash rate to 2%, let's imagine. Just imagine that the cash rate went up to 2%. So now we send the cash rate up to 2%. What's going to happen? Banks are basically going to have to pay, well someone's going to have to foot the bill. For $400 or $500 billion at 2%, that's $8 to $10 billion that somebody's going to have to take the bill. So if the RBA starts paying 2% on these deposits and getting nothing over here, so they're going to get zero over here because that's fixed. They're going to get 0.1%, let's just call it zero, for 3 years until the middle of 2024, because that's when these things mature. So they're going to get zero over here on this $500 billion, and they're going to have to pay 2% over here on this $400 billion. So it's going to be $8 billion out the door for the RBA. Let's forget about the 10 billion here. It's going to be $8 billion out the door. Now, you could say, well, they could just not pay anything to the banks. Well, then the banks are going to have to pay their depositors. So if you put the cash rate up, then all the liabilities of the banks is going to go up. Their deposit rates, the bank bill swap rate, everything on the right-hand side of their balance sheet, all their liabilities are going to go up. And they're going to continue to get zero here and have to pay out 2% to their depositors. So you can either impose a big loss. If the RBA was to raise the cash rate, it can either suck up an $8 billion loss or it can push it onto the banking system. So here are its choices: ruin its own income statement or weaken the banking system. That's the result of this. The result of this quantitative easing, which has caused this, means that if they raise the cash rate, they've got a choice between ruining their own income statement and making big losses, or materially damaging the stability of the banking system. So what are they going to do? They're just not going to raise the cash rate. That's what they're going to do. Until this goes away, which it does in 3 years' time, and in which case this will go away, until the problem goes away, they're just not going to face that other problem. They're just going to ignore it. Now, it's not impossible that they'll raise the cash rate, but that's a strong incentive and a little understood incentive for them not to do it. It'll put them in a difficult situation. It's also true, moving on to the second reason, I don't think the cash rate's going up for a long time. It's also true that the RBA is determined to defend the dollar. So the dollar's at 73, 74 at the moment. A big part of why they did quantitative easing was to increase the supply of Aussie dollars. And if you increase the supply of something, you reduce the price of it. They wanted to reduce the price of the Aussie dollar. And we're trying to keep it down in the face of the best terms of trade that we've ever had in Australia. You know, terms of trade means how many tons of iron ore does it take to buy a Toyota Corolla, okay? I know that's sort of economics 101 explanation, but let's just take it in those terms. Just how much is what we export worth relative to what we import? And of course, it's worth fantastically large amounts. And this would ordinarily drive the Aussie dollar way up. Now, the other thing, and it has been driving the Aussie dollar way up, and if it wasn't for the fact that the supply of Aussie dollars have been increased with quantitative easing and interest rates have been cut to such low levels, then the Aussie dollar would be at much, much higher levels. And it may yet go up. But if we increase interest rates, money will flow into Australia looking for those higher interest rates, and that will drive the Aussie dollar up. Money flowing into Australia looking for those higher interest rates is the selling of euros and renminbi and yen and dollars, and the buying of Aussie dollars. So the RBA is going to be very reluctant to raise interest rates because they want to defend the dollar. And then the most common thing that the governor says, Philip Lowe says, about raising interest rates is that he won't raise interest rates. This is like his mantra. We won't raise interest rates until the growth in wages is sustainably above 3%. And this is me trying to paraphrase him. Not paraphrase, this is me trying to not paraphrase him, but to quote him verbatim as closely as I can. Philip Lowe says after every meeting of the RBA, they meet once a month, they'll meet next Tuesday week, after every meeting of the RBA, I'm not intending to raise interest rates, the board isn't intending to raise interest rates until wage growth is sustainably above 3%. And I don't expect that to happen until 2024 at least. That's what he consistently says. And you can see where wage growth is, right? Now, it has ticked up a little bit, but 3% is a hell of a long way from where it is at the moment. And that's going to tick back down again once we get into Q3 after all the lockdowns. So that's the second thing, or am I on to the third thing? Maybe I'm on to the third thing. Here, and then my final thing is that they want to keep negative real interest rates to stimulate investment. Now, the investment that the RBA would like is in machinery and capital investment and the building of software. Corporate investment is what they would really like. Corporate investment is the thing that's most missing from here. It's the biggest missing part between supply and demand. Aggregate demand isn't growing quickly enough, and the number one thing that's missing is corporate investment. And corporate investment, companies, the lower the cost of capital, the more projects that are likely to go ahead. And so they want to keep the cost of capital down. To move, you can see how low corporate investment is, how historically low it is in Australia at the moment. And this is something that the governor talks about a great deal as well. Now, that has ticked up a little bit in the last few weeks as well, but all of those reasons point to the cash rate not going up. Now, what do the markets think? Well, we can see from overnight index swaps. I'm not about to explain what overnight index swaps are. It'll take me 30 minutes to explain what swaps are, let alone these tricky little things, overnight index swaps. But in any case, we can back out from them what the market expects to happen to the cash rate. And the market's expecting the cash rate to still be below 1% at the end of 2024. So even the market doesn't think that, which is usually more bullish about increases in interest rates here. Let me just remind you again about my course. And now we are at the end of the discussion. So I hope you found this helpful. It's really been trying to bring out these things. How much real interest rates have gone down, what that means for borrowers, for the trade-off between the risk that's being taken and the reward that's being received, and how much the risk-reward trade-off, how much more beneficial it becomes for borrowers when the cost of capital comes down. And it's come down absolutely massively. And it's turned around the world borrowers, not all borrowers, into lenders, because otherwise it'd be a disequilibrium, but it's turned a huge number of borrowers into lenders. And each of us has to think that through, especially if we have big cash balances. People who have big cash balances are basically looking at negative returns, loss of wealth on those cash balances over the next 2 or 3 years of 6 to 8%. There's a degree of inevitability about that. And so a recalibration of how much of cash balances and of leverage, and a rethinking through of strategy to match the new circumstances. This isn't like real interest rates have gone down a little bit and then they'll go back up again. They've gone down more than they've ever gone down. And they're staying down for a considerable period of time. And private investors just can't ignore that. They have to, the private investors themselves or their advisors need to think that through in terms of investment strategy. And the purpose of this webinar has been to try to help you to get going on that.